following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Welcome back to NinjaTrader Live. I'll be your host, Tom Schneider, CMT, for this segment, Traders Workshop, with Mike Arnold, returning guest. How you doing, Mike?
I'm doing well. Thanks for having me back.
Oh, it's great to see you, and jealous of where you are. That's where I want to be eventually, Arizona. Great spot. Love it.
Well, it's been fun. We finally got hit with a monsoon this weekend, so that's always exciting when you have the rivers flowing down the streets.
Oh, that doesn't sound good.
Well, it's built for that. You get the big wash areas, which big collection areas. So when I took the dogs out Sunday morning, what's normally dry, like a big desert dry basin, was all filled with water, and you had all the birds flying and landing in the water. The animals just love it. So
Oh,
it's sort of fun to see once the rain stops. But then the humidity's up, so then it's hot and humid.
right. Which you don't, you think of the heat. Well, it's a dry heat. That's what they say about Arizona, but maybe not this week.
It's when the monsoons hit, it's not so dry a heat anymore. It feels like Florida or worse than Florida.
Yeah, hotter, hotter. Well, we're glad to have you back. It's been a little bit. How's everything otherwise? Good?
Everything's good. Yeah.
Good. Great. Well, it's been, I don't know, a couple weeks, right? 2, 3 weeks of a little bit more volatility than we're used to, right? We've been kind of in this mode this year of slight grind, uptrend, uptrend, a little bit of a pullback in April, and then a resumption of trend. And I think the shock that happened 3 weeks ago, and some say it was the Japanese central bank doing their machinations to goose their economy, sent shockwaves throughout the market. No, that's okay. That's fine. We can have our reasons, but just curious to see how even in these markets where we go from low volatility, high volatility, back to maybe normal, what we've been used to volatility, kind of how you look at these moves in terms of what your indicators are telling you, Mike.
Well, at this point, we finally flipped back to with last Thursday's price action in the S&P. It confirmed then the probability shift to retest, at least retest the high areas. Uh, Next target up, the next major target is about 56.46 based off probabilities. Does it mean it has to stop there? No, but the probabilities are we will hit that even if we pause or have a slight pullback now, and then the march higher could continue. The only at this point negative, which is could be a major negative. Now remember, September going into September is historically the worst month on average. There's no guarantee. It could be a perfectly fine September heading into the election because the probabilities are still from the election cycle are still that the market's stronger, but you always got to look at September because that's generally the month that is the best to put on some downside hedges. Uh, so what's also interesting with that is if we look at the weekly chart on the S&P here, we've entered the area since we started trading about 55.70, 55.71. We've technically entered an area where we could have a double top pattern forming. That does not mean anything in the short term because probabilities are still higher for longer. But if we then reverse and close below at some point, below the August 9th, the week of the August 9th lows, and it was on August 9th, the low of 51.20 on the September contract. And then we'd have to, once we roll, we'll have to redo those levels for the Dece contract. But that would be potentially a wipeout moment for the markets. Now, that's a long way off from happening. I'm just putting it out there as a potential. Other than that, I'm still in the higher camp. If we do go and continue to march up and take out the highs from mid-July, that potential double top is still in play unless we trade through 58.72. 58.72 gives the all clear and that pattern's no longer potentially valid. And I just want to stress, because a pattern is a potential, you do not trade off potentials. It's something to watch out for. So therefore, I would structure things and know where my reward to risk and where things could tip back very negative very quickly. Other than that, I'm in the camp, at least in the short term, that the magnet prices are to the upside still. We're going to evaluate as we close in on the July highs, but we're at least focusing on that in the short term.
So real quick, that 58.72, can you explain, because that would be new highs, right? 58.72. What is that exactly, just for people who are new to, kind of
All right,
your
58.72.
indicators?
So this is called, as you know, I do harmonic retracements and extensions. So let me just remove something here, just so it's less confusing. All right. So right now, if we take the lows from the 5th
Mhm.
of August, which were the spike lows from that Monday, and we project backwards in time to the highs on July 16th, we can then do the 12.5 and 25% projections. Anywhere, if the market stalls out. So the way I use this now, because this gives me price projections to the upside, because again, if you go to all-time highs, well, how do I come up with targets? I got to come up with something. You can't use past price action.
Right.
So the areas I'd be watching is still, we have this, let me switch to the weekly again. We have this sort of upward sloping target trend line, and we have those harmonics. So I would watch if we start breaking above the 57.21. Again, we're focused on the September contract for a few more weeks. The next area I'd be watching is this 57.96, which is the 12.5 projection from those lows on August 5th to the highs, the July highs.
Mhm.
And then I come over here and look at that upper trend line. So that sort of gives me a rough price and time area to watch for the next key levels if we can manage to get through all-time highs. The next level up is the 25% harmonic. And again, that could keep extending out. If we go through the 25% harmonic, it would take, based off all the work I've done, it would take this potential massive double top off the table. What would that mean? It would mean that the levels calculated below with the high probability targets are no longer there. Would not mean that, hey, if we did close below those beginning of August lows, that there could not be continued pullback. It just means I cannot use the high probability targets. I have to use other price action targets. So that's how it's all structured. So I can take the guesswork out of my sort of analysis. So now I only have to focus on trade setups and proper reward to risk utilizing the targets. So that's how I've come up with my target structure, which I find is especially handy in markets going to new highs, or whether they be stocks or the S&P, the Nasdaq, whatever it be. When we go to new highs, you got to come up. Well, at least for me personally, I have to be able to come up with levels where either I'm raising stops, taking profits, or taking some kind of action. Could be a combination of those two.
Awesome. Okay, that's a great explanation. The key here, I always think about looking left, right? Which you can do in a lot of markets, but when you are making all-time highs, looking left doesn't do anything for you, except for the fact that you can find a range that works for you and extend it like you did with the 12.5%, with the 25%. And it also kind of fits in that pattern. Well, look, we had a pullback. And if we get to those new highs and extend 12.5, 15, or 25% beyond, it kind of goes into that continuation of that bull mode, which is an advancing wave pattern to some extent, right? Which is, you 3 steps forward, 2 steps back is kind of a trite way to say it, but in order to be in a trend, you have to advance, and getting past the all-time highs, first step. But once you get to that 12.5, 25%, you feel better about, okay, this is a bullish trend that's going to continue, especially into, like you said, September. We think of market lows of the year generally being October, right? We always hear about October lows. So that kind of fits in with September, right? You have to get to those lows through September, but you're right, balanced by this cyclical or seasonal pattern that we know that's called election year. And the question is, what's going to win out? We also throw in this change in Fed policy that's going to happen. I mean, it's like that movie Perfect Storm. Everything's coming together at once to see. And the question is, what'll win out? We don't know, but we can be prepared with these levels.
Correct. You can be prepared, and also that's why I prepare by, I'm willing to give up a little, especially if this keeps going the upside, a little of my upside potential to at least put on some downside hedge risks. I look to put them on through the duration of September into pretty much option expiration in October, because if you're going to continue the drawdown into October generally continues till at least around mid-month. Now, October is not, even though people say, oh, you can get crashes, everything else in October, October is not historically uh, the biggest risk month of the year. It is September. So
Right.
that's why I really like to be geared up. And there's many strategies you can use to put on things that don't completely cap the upside, but can possibly, all right, I'm willing to take a little risk off my downside to limit some returns on the upside in what could be in a historically very volatile period with a lot of cross currents. Do we know how the market's going to react? Again, there could be election surprises. Is the Fed going to cut in September? And then you have the historical natural patterns, and then we have on top of that price action. And could something else trigger again in the Mideast or somewhere else in the world that comes and is more of a blind side thing? For some reason, more often than not, it happens in the next few weeks time frame. So I have to be prepared for that. But until that happens, I can't just say I'm going to take my ball and go home. I just have to be prepared and structure trades appropriately given that historical information.
I agree. I mean, you're right. We didn't even talk about geopolitical and so many things. And it could just be so much information is at our fingertips now more than ever that it just seems like a lot. But maybe these risks were always there in some shape, way, shape, and form. And the markets are the first ones to know, I think, all of that stuff, for the most part. But with social media being what it is, more and more people are informed of this, which I think is a good thing. I think it's good that somebody like a retail trader, day trader, scalper, whatever you want to call that trader, is able to get information maybe even quicker than some of the institutions or hedge funds. I don't know if that's true, but everybody has Twitter, right?
Everybody has Twitter or X or what. I mean, sometimes I think you have to be careful that you're not getting information overload and whipsawing yourself because you don't know. Just because you see something scroll across the headlines, you don't know how the market's going to react to it. You can
Sure.
think that's bearish or that's bullish, and the market could take the complete opposite reaction, especially not necessarily the moment that hits, but within, a day or two. So back to where we started this conversation is why I have to work out my levels, my probabilities, and then trade these setups, not what I think's going to happen, but what those setups are showing me, and then structure the trades appropriately, not just saying, oh, I think the market should do this, therefore I don't know. I don't have a setup, but I think it should go down, so I'm just going to sell.
Right.
That's not long term. That's probably not the best strategy. Or I think I'm going to buy. A lot of people are telling me, "Oh, it's guaranteed September rate cut, fine," but they're like, "It's the market's going to take off and go screaming." And I'm like, historically, that's not true. When the Fed starts its next cutting cycle, you could see a 1 or 2 day reaction to the upside. But generally, when a Fed starts its cutting cycle, it's not necessarily positive for the markets, especially when the economic indicators and data is rolling over that we could be headed into or might already be in recessionary territory. So when you're cutting and you were already or potentially going into recessionary territory, it's generally not net positive for the market over the mid-term, especially once the yield curve starts to uninvert.
Well, right. And the reasons for the cuts, right? Weakening labor market is what they're looking at now, and it's time to cut rates. That reaction might be just the notion that okay, we have a little bit of clarity, right? And that could be the 1 or 2 day reaction of okay, good news, right? But then when you think about it, the fundamentals of why they're cutting, it's to avoid or to goose the economy, right? It's to jazz up the economy and make it easier for businesses to conduct business and to invest in capital and all this good stuff. Shows a weakening economy, which you're right, for the market isn't very bullish.
And you can't have it both. Everybody's citing the lag effect on the way up. Well, the Fed's behind the curve. They should have started cutting. It's the lag effect. It's the lag effect. Well, you also get the lag effect on the cutting cycle too. It's not like you cut 25 or 50 basis points and all of a sudden everything is
It's rosy.
everything's hunky dory.
Right.
It's you get the lag effect, and
Yeah.
these things take a long time. And I think sometimes people use it on one side of the argument, but then forget about it on the other side. Like, let's even say they did a 50 basis point cut, which I would think the market would sit up and say, notice to say, okay, then you paused in July and now you're having to do a 50 cut instead of just a 25 cut. I think that would make the market sit up and really take notice and all right, what's really going on underneath that we're not necessarily seeing right now. But again, even a 50 cut isn't going to drastically turn around. It's like a big oil tanker. It's not a speedboat. It takes a while to turn around.
Right.
So
Right.
people forget about that and they get into the short term. The Fed's going to save everything. The Fed's going to save everything. And then when you step back and look at it, what's it really showing us? And again, I don't know. I got to trade the patterns and the probabilities. I have to trade the setups, not what I think's going to happen, but what the market's telling me the most likely outcome. No, not a guarantee, but the most likely outcome is from the shorter term and medium term price action.
Well said. I like that. Can we take a look maybe back? Let's go back to your chart and can we take a look? Do you have a NASDAQ analysis?
Yeah. Yep.
Because NASDAQ has seen a little bit of the bloom is coming off the rose with NASDAQ, right? It was the darling in the earlier part of the year. We saw maybe talk of rotation in the Russell, so maybe Russell got a little bit of a bid and NASDAQ came off, but now with the markets reacting kind of the same way, not in lockstep, but pretty close. It's just a little weaker than the E-mini. Just curious what you're seeing.
And the NASDAQ hasn't fully shifted the probabilities yet. They might shift on today's close as long as it closes above about 19,621.
Hmm.
The probability shift that it should not, we can still get pullback moves because we are in the short term very overbought, but we should still then shift. My next area I'd be looking at for the next key significant target is right around 20,050 to 20,100. I would not go all the way to 20,500 just yet. It'd be around 20,050 to 20,100 100, which would then put us in potential double top territory. Again, it's potential, may never come to anything, but the Nasdaq's definitely uh, lagging. You can see we are getting some buying pressure coming in after Thursday's big rally, but from the harmonic standpoint, the probabilities have not tipped yet. Even Friday's close just missed tipping the probabilities. So that's what I'm paying attention to. If the probabilities shift, I'll be watching for key pullback moves. And then personally, my target will be that 20,050 to 20,100 area, which is also the little bounce before we started cascading down. So that's going to be a key price target area for me.
Yeah, and you're talking that little bounce was in July, right? It
This little
was
bounce, yeah, the July 22nd, it was pretty much a one bar bounce.
yep.
And it stalled the next day, stalled out on the 23rd. The high was right around 20,084. My harmonic is 20,075. So you see, I'm going again, I'm not trying to pinpoint something to a penny.
Right,
I'm
right.
trying to give an area that is okay on any short-term moves. That's my magnet price area. If we get through that area, then my next price, because we'll be in the probabilities continue to move up to higher prices, but before I can even worry about getting to new highs in the Nasdaq, it's this 20,500 area, 20,525 area that's really a major stalling point if it can even get that high.
I was noticing you mentioned the bounce, and it bounced right up to your 8 period moving exponential. I just I love the way the 8 period is can act as support resistance pretty consistently, when there is a move, when there is a reaction, right? So short-term moving average, short-term reaction, maybe it's reaction due to news, whatever it is, and then failure, right? In that case, it bounced up and failed, and it just stayed with that eight period moving average. I love that.
And just that's a clarification. That's a good point. That's an excellent point. That's why I love the eight. And in the short term, we are very overbought. We could pull back, but here's what I'm watching, whether it's, the price levels are going to be differently between the S&P and the NASDAQ. I'll just show it here. We're getting the first cross area, at least in NASDAQ, of the potential rotation zone shifting back up. You mentioned the 8, which is the yellow line. We have the blue, which is a 21 EMA. We have a prior very significant level right around this blue horizontal line I've on there, right around 19,150. Just above there, we have the hooking up 50 exponential. So on any pullback, this area right in here, roughly between about 19,150 to 19,000, just go to 19,300, I'd be watching for key support on any pullback if it can get back that far. So especially if we close today above 19,621, then the probabilities have shifted. We should see some higher price action continue, but on any pullback, that's where I'd be watching for a pullback entry signal for a rotation back up in the short term.
And it's right at that 50% retrace, right?
Correct. And now see that we've talked about this in the past too. This forms a cluster. I have prior resistance becoming confirmed support where it also paused last Wednesday. It was also back and forth across that level in the end of July before the last major drop, and it's the 50% harmonic level, which it paused at last Wednesday, and then we plowed through it. So that's going to be a key cluster area. I love when things cluster together because it's whether you're watching one thing or another, because some people, and whether you're watching, that 50% level, because people look at it in terms of Fibonacci, even though it's technically not a Fibonacci number,
Right.
people watch it.
Right.
And people watch whether you're watching the 8 EMA or the 10 EMA or something else, or whether you're watching the 20 or the 21. There's lots of things in that area. So lots of different sort of systematic traders that might have their things structured differently. there's a lot of things that are going on that could lead, if we do pull back there, to some kind of buy bounce that could then propel the next leg higher. Because again, they've pretty much gone in a pretty straight direction since the rally snapback buying pressure on the 8th of August. But
Hmm.
again, I would be shocked if we didn't at least get a pause, even in our rally up in June. You got things like 3-day pauses before the next push higher. You got a couple days, a 3-day drop. So could I either see some kind of minor, and that wouldn't even be a big drop. That would just be a minor pullback, and then the next leg push higher. Yeah.
Yeah, that's interesting. You meant I really didn't notice that there hasn't been a red candle since we the eighth, when we crossed back above our 200-day moving average and we took out the previous three candles, kind of the recovery from that absolute disastrous Monday. Um, and so we haven't had any kind of pullback. I mean, yeah, you could argue these small body candles are pauses, but they do slightly advance the football, if you will, right? Even if it's so slight. Um, it's not looking like the trend we saw from, let's say, April lows to July's highs, where you did see some pauses, you did see some pullbacks. And, I get a little worried when that happens because it just every trend should have a little bit of a breather, a little bit of a pullback before it continues.
What's healthy price action? And I mean, you have to trade what the market gives you, but when the market doesn't even give you a pause slash pullback, I mean, a pause would even be we could get 2 or 3 days of sideways price action. We have Powell speaking on Friday. That could be a correction. A correction does not have to be a big pullback move. A
Right.
correction can be a sideways move.
Yes.
And that's what sometimes people forget about. They're always looking for the pullback, and then the market doesn't necessarily pull back to their key levels. For example, on one of the live streams I pointed out, I'm back to the S&P now, but we rallied from the end of May lows to the about third week in June. Then look at this. Yeah, you had a little 3-day pullback, but this was more of a sideways correction. Look, if you could draw horizontal lines around this and look at it just as a horizontal channel
Sure.
that
Right.
is just moving sideways to really work off this short-term overbought conditions, and it really didn't go down that much. Yeah, you had a couple red candles. So could I easily see that happening? Yeah, and even on the S&P, we just talked about the key levels on the Nasdaq. If we did get even a slightly bigger pullback, my cluster area is roughly 5,500. Why? We have the hooking up 50, we have the 8 EMA, we have the 21 EMA just below that level. We have the prior 62.5 harmonic, which once we got above that, flipped the probabilities to higher for longer. And we have some key prior resistance becoming support in that area. So
Yep.
that would be the area, if it did manage to get at least a multi-day pullback, I'd be watching for. But I'm not so sure we'll get that. We could get more of the sideways correction again, especially with basing. I mean, even on a pullback to, you see all these highs. We had the high from the 25th, the 26th, the 29th, the 30th. All these key highs right in here.
Right.
And
Yeah.
we broke above it, sustained one day above it, but then closed back below all those key highs. That's a very key area, and that's still above that 5,500. That's about 5,530, which we tested with roughly Friday's lows. So we could even pause, pull back, stay in the range of Friday's key lows, which was also major resistance before, and set up a sideways correction and then make the next push higher. So
And
I
Mike,
know the two things I'm watching for. If we do start breaking below Friday's lows in the S&P, I'm watching for the pullback closer to about 5,000, and then I'll start looking for more short-term bounce signals. If we base and we could even pull back, but we continue to remain above last Friday's low areas, I'll be watching for the sideways correction, just as we did in the end of June. And then I'll be watching for the resumptive trend breakout play, which from the end of June was on July 2nd. You can see that key close. This was the day that broke above and was able to sustain a close, a move into the close. Remember, closing price is most important. You see it tried to break out at the end of June and could not sustain the close, but this one did, and then it continued to march higher. So if we get a sideways correction, I'll be watching for that breakout play higher.
So real quick, Mike, and then we're going to wrap up. Those highs that you mentioned at the end of July, they were held back by the 8-period moving average. And now, if we get back there now, look what's coming up to save it, the 8-period moving average. It might be support.
Exactly.
Yeah.
Precisely spot on. So now
something to watch
my
out
whole
for.
thing with this, I'm trying to lay out my thought process for people, not so they can do exactly what I do, but I'm trying to point out what I notice and that I'm lining up very key levels. And if this happens, this is what I'm watching for. If this happens, then this is what I'm watching for in the levels. So by setting up a plan in my mind, I can at least prepare with a couple outcomes so I'm not analyzing minute to minute and reacting to the market. I'm letting the market tell me what it's going to do, but I know the key areas I'm watching. So I can go into each day saying, okay, here's what I'm looking for. Now, could something come out of left field? Yeah, that's part of trading. Then I'll have to redo my analysis. But so far, I've laid out exactly what I'm watching to everybody.
Awesome, Mike. We really appreciate you coming on and explaining what you're looking at and how you look at the markets. It's fascinating and it's great to hear. So, where can people find you?
Easiest thing to do now, they can still try to follow me on Twitter at MG Arnold. If my account does not get suspended again. Uh, Oh, the best way to just search on YouTube. I'm on YouTube every day live. Path Trading Partners. Just do a search. You'll find me. You can watch it live. You can watch it on replay. If you want to know the latest levels I'm looking at on a daily basis, that's where to find me.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.